Momentum is one of the most widely used concepts in Forex trading, and it's also one of the most commonly misunderstood. The word itself sounds simple. Something has momentum. It's moving. It has energy behind it, so you should buy it, ride it, and profit. And that framing is not entirely wrong, but it is incomplete. And the incompleteness is where most traders run into trouble. Momentum is not a strategy on its own. It's not a signal system, and it's not a predictive tool. It's a measurement, a way of describing what price has recently been doing, and it's only useful when you understand that what measurement actually represents and where it belongs in a larger analytical framework. I wrote an article on this at positionforex.com, and the link is below. Covers 4 momentum indicators in detail and explains how they fit into a complete technical approach. And in this video, I want to build the conceptual foundation underneath that. I want to explain what momentum actually is, why it exists as a concept in markets, how experienced traders think about it, and where the common understanding breaks down, and how it fits and does not fit inside a position trading approach. So, this is not a tutorial. I'm not going to walk you through indicator settings or entry rules. This is a framework video. And if you understand momentum at this level, everything else about using it becomes much clearer. So, let's get into it. Momentum, in the context of Forex trading, is a measure of the speed and energy behind a price move. That is its precise definition, not direction, not a trend, speed and energy. Trend measures where price is going over time, and whether it's making higher highs and higher lows or lower highs and lower lows. Momentum measures how forcefully it is getting there right now. You can have a bullish trend with weak momentum. Price is still moving higher, but slowly and with low conviction. You can have bearish momentum reading inside a bullish trend, which typically means price is pulling back within a larger move that is still pointed upward. This distinction is critical, and it's a distinction that most traders blur. Momentum indicators like the RSI, stochastic, CCI, and TSI are all measuring versions of the same underlying thing, whether a recent price movement is accelerating or decelerating, and whether price has reached an extreme in either direction. Overbought and oversold readings do not mean a reversal is coming. The mean price has moved aggressively in one direction over a recent period. That's all. Momentum is also not a predictive tool. It's reactive. It measures what has already happened in price. And this is not a criticism of momentum. It's just an accurate description of what the tool does. Understanding that distinction fundamentally changes how you use it. Momentum is a description of current price energy, not a forecast of future direction. Momentum exists as a concept because price does not move in straight lines. Even in a strong sustained trend, prices accelerate and decelerate. It pulls back, it consolidates, it re-energizes, it pushes forward again. That rhythm is not random. It reflects the ongoing interaction between buyers and sellers at different price levels and across different time horizons. Momentum measures where we are in that cycle at any given moment. The practical value is this. If you can identify when short-term price energy is turning, when a pullback is losing momentum, and the broader trend is beginning to reassert itself, you have a more precise point to consider entry than simply looking at a moving average or a trend line. That is why momentum emerged naturally as a tool in technical analysis. It filled a specific gap. Trend tools are good at identifying direction. They are not good at identifying timing within that direction, and momentum fills that gap. The overbought and oversold conditions that momentum indicators generate represent price extremes, points where the recent move has been aggressive enough that a short-term pause or reversal becomes more probable. Not certain, just more probable. That probability is what gives momentum-based entry timing its value. Momentum also exists because markets are driven by participant behavior. When a large number of participants are all acting in the same direction over a short period, when conviction is high and energy is strong, that behavior tends to continue until it reaches an exhaustion point. Momentum indicators help identify those exhaustion points by quantifying the intensity of recent participation. That is why momentum is a real and useful concept. It's not arbitrary. It reflects something structurally true about how markets move. I do not think about momentum as a signal. I think about it as a layer of context, and that reframe changes everything about how the tool is used. When I look at a momentum indicator, I'm not asking, should I buy or sell? I'm asking, what is the current energy state of this price move, and how does that fit with everything else I'm seeing? If the trend is bullish and momentum is pulled back to neutral or slightly oversold, That is a different environment than a bullish trend where momentum is already in overbought territory. Same trend, very different energy states. The appropriate interpretation of each is different, not in terms of entry mechanics, but in terms of what the market is telling me. I also treat momentum as confirmation, not cause. The cause of a trade is the structural case, the trend, the support and resistance level, the broader context. Momentum confirms that price energy is aligned with that case. When momentum turns upward at a key support level within a bullish trend, that convergence adds weight to the structural argument. The momentum reading alone carries very little weight. This is where my approach diverges most clearly from what I see from many retail traders. Many traders use momentum indicators as the primary basis for entering. The indicator crossed the threshold, so they take the trade. I use momentum to confirm what the broader structure is already suggesting. I also pay attention to what each tool is actually measuring. RSI and stochastic are calculated differently. One uses price differences over time. The other uses price relative to its recent range. CCI measures deviation from a moving average. TSI uses two smooth moving averages to reduce noise. Each tool measures a slightly different aspect of price energy, and knowing what each one measures informs how much weight I give its signals in any given context. The most common misunderstanding of momentum is treating overbought and oversold signals as directional. When RSI moves above 70, many traders see that as a sell signal. When it moves below 30, they see it as a buy signal. The logic seems reasonable. If prices move too far too fast, it should reverse. But that logic breaks down in trending markets. In a strong bullish trend, RSI can remain above 70 for extended periods. Price continues higher. Every trader who sold the overbought reading was wrong. Not because the indicator was wrong, but because they misunderstood what it was communicating. It was communicating that price had significant bullish energy. They interpreted it as a reversal warning. Divergence is another common misapplication. Divergence occurs when price makes a new high, but the momentum indicator does not confirm it. Many traders treat this as a reliable reversal signal. Divergence is possible, but it's unreliable without additional context. It can precede a reversal, can also precede a continuation. Without the structural context to support it, divergence alone is not a sufficient reason to trade. The deeper structural misunderstanding is using momentum indicators as standalone decision tools. Momentum is designed to operate as one layer within a multi-layered analysis. When it's isolated from trend, support and resistance, candlestick behavior, and broader context, it generates noise far more than it generates a signal. The misunderstanding persists because momentum indicators are visible, responsive, and produce clear outputs. That clarity feels like information. But clarity of display is not the same as completeness of analysis. The indicator looks decisive. The analysis behind it is not. Position trading operates on weekly and daily time frames. That context significantly changes the role of momentum. At higher time frames, momentum signals are slower and cleaner. A weekly RSI reading reflects weeks of accumulated price behavior, not hours or days. That makes it more meaningful as a measure of trend energy and less prone to the noise that can create false signals on shorter time frames. One thing I have observed over years of trading is that longer-term momentum signals reflect the activity of large, patient market participants more accurately than short-term signals do. And at the weekly level, momentum readings carry more structural weight for that reason. Where momentum fits in position trading is specifically in entry timing within an established trend. The framework I use looks like this. A trend is identified on a higher time frame, a pullback occurs, momentum turns neutral or slightly bearish during the pullback, and then price energy begins to turn back toward the trend. That transition from pullback momentum to trend resumption is where momentum provides genuine value to the position trader. Where momentum does not fit is as the foundation of a trading decision. At any time frame, and especially at higher time frames, making a decision primarily because an indicator crossed a threshold is structurally insufficient. The trend must be established. The level must be meaningful. The candlestick behavior must confirm the turn, and momentum confirms all of that. It does not replace any of it. Momentum also does not fight in isolation during high volatility events. News-driven price spikes can generate extreme momentum readings that have no structural significance. A momentum indicator spiking during a major news release does not provide useful information about trend energy. It reflects a temporary disruption in normal market behavior. I've learned to recognize that distinction and to weigh momentum readings accordingly. Momentum is a useful concept when it's understood correctly. It measures the price of energy. It identifies overbought and oversold conditions. It helps time entries within established trends. Those are real, practical applications. But momentum is always a layer, never the foundation. The foundation is structural analysis, trend, support, and resistance, macro context, and candlestick behavior. Momentum confirms and refines that foundation, does not create it. For position traders specifically, patience is what allows momentum to be used properly. You wait for the trend to establish, you wait for the pullback to develop, you wait for the momentum to turn. The convergence of these conditions, trend, level, momentum confirmation, is where higher quality entries exist. That process takes time. It requires watching setups develop without acting prematurely. It requires understanding that a single momentum reading, in isolation, says very little, and it requires trusting a multi-level framework over any single tool. The complete framework for this video is available in my article at positionforex.com, Momentum Trading, 4 Strategies for Your Arsenal, and it's linked in the description below. It covers all 4 momentum indicators in depth, explains how overbought and oversold conditions should be interpreted in context, and walks through combining momentum with trend, support and resistance, and candlestick analysis for higher quality entries. It's a reference piece designed to remain relevant throughout your development as a position trader, and until next time, best to your trading.